Welcome to the debate. When you look at the ocean, you don't stare at the specific shapes of the waves to predict when high tide will arrive. You look at a clock. You look at the lunar cycle.
Right. You look at the underlying schedule.
Exactly. Yet when intraday traders look at financial markets, they frequently they just ignore the clock entirely. They stare at the shapes of the waves, the geometric chart patterns, and wonder why they end up drowning. Today, we are exploring the structural mechanics of financial markets, specifically focusing on the time of interest or TOI hierarchy.
Which is a fascinating framework, really.
It is. And we're examining a core tension that emerges from the source material we are discussing today. The question is, does market behavior primarily operate on a rigid timeline where time dictates price and price dictates pattern, meaning time points to price, which points to pattern? Or are specific price levels and structural liquidity sweeps the true foundational drivers, with time windows merely serving as, correlated background noise?
Yeah, the classic chicken or egg problem for traders.
Precisely. I will be arguing that specific algorithmic time windows are the absolute primary filter for market validity. Without the correct time, every price level and every beautiful structural pattern is essentially a trap.
And I will be offering a contrasting perspective. While the time of interest framework is an undeniably useful way to organize the trading day, I will argue that price-driven liquidity sweeps and structural shifts are the true foundational drivers of the market. Time windows don't move markets.
You don't think so?
No, I mean, the targeting and purging of resting liquidity moves markets. Without a requisite liquidity sweep, a time window is functionally meaningless. It's just a number on a clock.
Let's lay out our core position so we know exactly where the battle lines are drawn. From my perspective, the primacy of the time, then price, then pattern rule, it just cannot be overstated. We cannot reverse that order.
So you're saying the pattern is secondary?
It's entirely irrelevant unless it appears during a designated time of interest. The highest probability algorithmic delivery times for institutional intraday moves are strictly bound to very specific windows. We're talking primarily about the 2:30 to 4 a.m. window, New York time, for the London session.
Right, the classic London setup.
And the 9:30 to 11 a.m. window for the New York morning session. These aren't just polite suggestions, These are the exact periods when institutional algorithmic delivery is active. If you see a flawless structural setup at 6 p.m., it is a mirage.
Because the volume isn't there.
Exactly. The algorithm is dormant. The temporal mandate hasn't been given. Therefore, time is the supreme independent variable that validates the price action.
I understand the appeal of that rigidity, I really do. It provides a sense of safety. But when you look at the actual mechanical realities of how institutions trade, a different story emerges. Yes, the TOI framework provides a schedule, but what is actually happening on that schedule?
Algorithmic delivery.
But every major time window's entire purpose is defined by targeting specific price levels. We are talking about purging liquidity from an Asia session high or low, a London high or low, or a previous day high or low. Let's look at the 2:00 a.m. London Open.
Okay, let's look at it.
The explicit purpose of this window is the beginning of a liquidity purge. It doesn't spontaneously generate volume out of thin air just because the clock struck 2. It needs fuel. And, that fuel is resting liquidity. Price is the engine of institutional movement. And therefore, price is the true catalyst here.
I see why you think that. But let me give you a different perspective on how these setups mechanically unfold. If we walk through the life cycle of a standard institutional trade setup, the temporal boundary is always the first insurmountable gate.
How so?
Think about the standard 5-step TOI trade setup. Step 1 is establishing a higher time frame bias. Say we are bearish for the week. But look closely at Step 2. Step 2 is explicitly wait for the London time of interest.
Right, wait for the window.
You literally have to wait for the clock to strike between 2 a.m. and 4 a.m. It is only after you cross that temporal threshold that Step 3, the liquidity sweep, can even be considered. Think of it like this. Trading outside of a designated TOI is like trying to catch a train when the station is physically closed.
Okay, I like that analogy.
The physical tracks, which in our market are the patterns, the support, and resistance levels, they are still sitting there on the ground. You can point to them. But the engine, the institutional algorithmic volume, simply isn't running. You are waiting for a train that isn't scheduled to depart.
I come at it from a different way because while that train station analogy is elegant, it obscures the actual market mechanism at play here. Let's really examine what happens at that 2:00 a.m. London Open. You're arguing the clock strikes 2:00 a.m. and the station opens.
That's right.
But the specific event triggered at that exact moment is a liquidity purge of the Asia high or the previous day high. We need to explain why that happens. Why does the algorithm target the Asia high?
Because it's seeking liquidity. Exactly. Because that's where retail traders place their overnight stop losses. If an institution needs to short a massive block of currency, they need an equally massive pool of buyers to take the other side of that trade without causing extreme slippage. Where are those buyers?
Sitting above the high.
They are sitting right above the Asia high in the form of retail buy stops. That purge is the mechanism. If time were truly the primary driver, the unyielding absolute you claim it is, then the market would just reverse at 2:30 a.m. regardless of where the price was on the chart. The algorithm would just say, it's 2:30, time to execute the macro. But it doesn't do that.
But it does need the price condition to be met within the time window. That is exactly the second part of the rule, time, then price. The algorithm is programmed to seek that liquidity, yes, but it is programmed to do so at specific times.
Exactly. But the dependency is fundamentally heavier on the price action than you're admitting. What follows the liquidity sweep? A smart money reversal.
Right, the reversal pattern.
That violent change in direction where the market suddenly drops after taking out those highs, that reversal is a direct reaction to the acquisition of liquidity. It is the institution successfully filling its massive order and then aggressively repricing the asset.
Within the time window.
But if the Asia range is completely disjointed, or if price hasn't reached the previous day high to trigger those resting stop-loss orders, the algorithm doesn't just blindly reverse because the clock struck 2:30 a.m. It seeks the liquidity first. It extends the window or it manipulates price further until the counterparty liquidity is secured.
I see your point.
Therefore, the architectural reality of the price dictates whether the time window produces a valid setup or just a messy, unplayable chop. Time is just the arena. Price is the gladiator.
That's an interesting point, though. I would frame it differently. We aren't arguing that price is irrelevant. Obviously, a market is a mechanism of price discovery. We are arguing about the hierarchy of filters that protect a trader. Let's move beyond the London Open and look at the session structure as a whole to illustrate this.
Okay, let's look at the sessions.
The market operates on a very strict hierarchical chain. The Asia session leads to the London session, which leads to New York AM, then lunch, and finally New York PM. Let's focus intensely on the New York AM session TOI from 8:30 a.m. to 11 a.m.
The highest volume of the day.
Exactly. This is the major U.S. session movement. We know that 9:30 a.m. to 11 a.m. is one of the absolute highest probability algorithmic delivery times in the world. The reason I place time at the top of the hierarchy is because these algorithms operate on strict temporal mandates from central banks and major institutions.
They have schedules to keep.
Yes, they are injecting macro-level volume into the market at 8:30 a.m. for news embargoes or 9:30 a.m. for the equities open. Let's talk about the shared pain so many market participants experience. If you're listening right now and wondering why your 10 a.m. breakouts work, but your 7:15 a.m. perfect flag patterns fail miserably, this temporal hierarchy is the exact reason why.
The trap setups.
Right. If you have a beautiful structural pattern forming at 7:15 a.m., it is almost certainly a false signal, a trap. The major algorithmic participants haven't been given the temporal green light to deliver volume. The time dictates when the true moves are allowed to happen.
I'm certainly not going to deny the strength of the algorithmic timing argument there. It is undeniable that volume profiles absolutely spike during those New York AM hours, specifically right at 9:30. But let's look at the conceptual framework of that chain reaction you just laid out.
Sure.
The foundational rule of this daily cycle is that each session explicitly references liquidity from the previous one. This is profoundly important. It means the New York AM session doesn't exist in a temporal vacuum. Its entire structural purpose is to target the liquidity pools left behind by the London higher low or the Asia higher low.
Correct, which perfectly follows a time then price model. You arrive at the New York time window, and then you look for the London price levels.
But consider the mechanical implications of a failure in that chain. What happens if the London session fails to create a clear, distinct high or low? What if London was just a low, volatile, messy consolidation because of a bank holiday in Europe?
Well, then you don't have a clean setup.
Exactly. The entire framework relies on a chain reaction of structural price points. If the structural price points aren't there, the New York AM session has nothing to target. You can sit there at 9:30 a.m. watching the clock tick, feeling incredibly disciplined about your timing, but without the defined liquidity pools created by previous price action, the algorithm has no defined objective.
I mean, that's just a no-trade condition.
Furthermore, think about the final step of a trade setup: confirmation. We are looking for a market structure shift, which is essentially the exact moment the trend breaks its previous pattern of highs and lows with aggressive momentum. Or we are looking for a breaker block, where a failed support level abruptly flips to resistance.
Both highly reliable patterns.
Identifying these mechanics requires definitional precision in price action. Recognizing a true market structure shift requires the intellectual humility to read the chart as it actually is, rather than blindly trusting that because it's 10 a.m., the sudden downward movement must be a valid reversal. The structural reality validates the time, not the other way around.
I'm not convinced by that line of reasoning, because you're treating the absence of a perfect setup as a flaw in the time-first hierarchy. If London doesn't create a clean high, and New York AM has no clear target, the time-first rule is exactly what protects you.
How does it protect you?
You check the time, it's the New York AM session. You check the price, you see there are no clear London liquidity pools to sweep. Therefore, you do not look for a pattern, you sit on your hands. Capital preservation is achieved. The hierarchy worked perfectly to keep you out of a bad trade.
That's a fair way to frame it.
But if you want the ultimate proof that time is the absolute master of this market, we have to look at the graveyard of failed trades. We have to look at the lunch session.
Ah yes, the great anomaly. We've all been caught in that.
It is the ultimate proof of the time dictates price dictates pattern axiom. The lunch session is generally defined as 11:30 a.m. to 1 p.m. New York time. The rule here is unambiguous. Most professionals avoid trading this window. Why? Because it is characterized by low volatility, endless consolidation, and crucially, random price movement.
Random is a strong word, but go on.
Think deeply about the implications of the phrase random price movement. If price and liquidity were the ultimate unyielding masters of the market, then a liquidity sweep at 12:15 p.m. should trigger a highly probable market structure shift and a clean entry, just like it does at 3 a.m. But we all know it doesn't.
No, it usually just chops around.
We've all been there, staring at a chart at 12:15 p.m. We see a sweep of a local high. We take the short bait and immediately watch the market chop our stop loss to pieces for the next 45 minutes. During lunch, the structural mechanics break down, patterns fail, liquidity sweeps lead to more chop. Why does this happen?
Because of the time of day.
Because the time is wrong. The institutional algorithms step back. It is the withdrawal of the temporal mandate that causes price and pattern to become random and toxic. If price were king, lunch wouldn't matter. The fact that lunch matters entirely proves time governs everything.
That is a compelling argument, and it's a trap that countless traders fall into. But I'm sorry, I just don't buy the conclusion that the lunch session proves time is king. Let me tell you why.
By all means.
You are looking at the lunch session in isolation, rather than seeing what it is actually doing structurally to set up the rest of the day. I agree that lunch is a consolidation period, where traditional continuation patterns often fail, but I frame it entirely differently. To understand lunch, you have to look at the New York PM session that immediately follows it.
The PM session is a completely different beast.
Exactly. The PM session runs from 1:30 p.m. to 3:30 p.m., and it is heavily utilized for indices like the NAS 100 and the S&P 500. What is the typical foundational pattern for the PM session? It is literally defined as a two-part process. The lunch consolidation followed by the PM expansion move.
Right, and that expansion happens when the PM time window opens at 1:30.
Yes, but the expansion is mechanically and entirely dependent on the consolidation that preceded it. The lunch session isn't random in the sense of being broken or devoid of algorithmic presence. It is a strictly necessary structural phase.
Necessary for what?
Consolidation is the market's way of building up orders, generating tension, and creating very tight, very obvious liquidity pools on both sides of a narrow range. I like to think of it as dynamite and a detonator. The algorithm isn't just turned off at lunch, it is purposely compressing the spring.
It's setting up the afternoon traps.
It is allowing retail traders to build a dense wall of stop losses just above and just below a very tight trading range. That trapped, concentrated liquidity is the dynamite. When 1:30 p.m. hits, the PM expansion uses that exact lunch consolidation as its fuel to drive the afternoon trend.
But it still waits for 1:30.
If a lunch period was a massive, volatile, one-directional trend instead of a tight consolidation, the PM session simply wouldn't have the compressed liquidity needed for its typical violent expansion move. Therefore, even the supposedly dead time of lunch is fundamentally a price action-driven setup. It is a resting phase dedicated entirely to liquidity generation. The market is still operating on a deep structural logic. It isn't just taking a nap because the clock struck noon.
That is a very vivid way of looking at consolidation, and the dynamite and detonator analogy is powerful. But it actually proves my point. You can have the tightest consolidation in the world at 12:30 p.m. You can have mountains of dynamite sitting there in the form of retail stop losses.
Right.
But if you try to trade a breakout or a sweep at 12:30 p.m., you are likely going to get chopped to pieces. The explosion doesn't happen. You must wait for the time of interest. Time is the filter that tells you exactly when the structural tension is allowed to resolve into a valid tradable trend. You can't blow up a building with just the dynamite. You need someone to push the detonator.
I certainly don't disagree that the 1:30 p.m. window is the detonator, but my point is that the cause of the violent PM expansion isn't the physical hands on the clock moving to 1:30. The clock moving to 1:30 doesn't magically create a 50-point drop in the NAS 100.
It's the trigger, though.
The cause is the accumulated liquidity from the lunch consolidation. If there is no consolidation, if the morning trend just slowly bled out all day with no buildup of tension, then the 1:30 p.m. window will be entirely flat. The detonator gets pushed, but there's no explosion because there's no dynamite.
So you're saying the fuel is more important than the spark?
The clock is just a trigger mechanism. The price and the liquidity are the actual explosive force. The market moves to seek liquidity. It often does so on a schedule, yes, but it is the liquidity, the fuel, that dictates the magnitude and validity of the move, not the clock.
And yet you cannot have the institutional delivery without the schedule.
This brings us to a fascinating juncture, because I think we've mapped out the boundaries of this framework quite thoroughly. Let's summarize where our respective positions stand after this exchange.
Sounds good.
My position remains firmly rooted in the strict, disciplined application of the hierarchy time points to price, which points to pattern. Honoring the strict TOI timeframe, specifically the high probability algorithmic delivery windows of 2:30 to 4 a.m. and 9:30 to 11 a.m., is the ultimate armor for a market participant.
It definitely keeps you out of trouble.
It filters out false structural patterns. It saves you from the toxic algorithmic randomness during periods like the lunch session, and it ensures you are only deploying risk when the institutional engine is actually running. Time is the essential, uncompromising filter of the market.
And my summary is that while we must absolutely respect how time windows organize the trading day, the fundamental mechanics of market structure prove that the market is ultimately a mechanism of price discovery and structural tension. Every time window exists to serve a specific price objective.
Liquidity purges.
Yes, the liquidity purges of the Asia or previous day highs, the mechanical formation of breaker blocks, and the constant referencing of previous session liquidity all demonstrate that price action is the true independent variable. Yes, algorithms execute on a temporal mandate, but they cannot execute without counterparty liquidity. Therefore, it is the liquidity, the architectural reality of the chart, that dictates the usefulness of the clock.
It seems we have found a significant point of convergence despite our differing lenses. We both agree on when the most significant institutional moves happen. Neither of us is arguing that someone should be actively trading the NAS 100 at 12:15 p.m. expecting a massive trend. We agree on the map.
Yes, we absolutely agree on the schedule. Our disagreement remains strictly on the underlying root cause of the behavior. Are we moving because the algorithmic schedule demands it, or are we moving because the structural liquidity requires it?
Exactly. And exploring this tension between algorithmic time windows and structural price action fundamentally deepens our overall understanding of market mechanics. It forces us to move past simple geometric pattern recognition and forces us to ask why the market is moving. It reveals the underlying logic of institutional delivery.
Absolutely. And honestly, there is so much more to explore within these concepts. We haven't even touched on the micro nuances of specific entry techniques inside those mitigation blocks.
Oh, entirely.
Or how to properly construct that step one higher time frame bias that frames the entire day's narrative before the clock even starts ticking.
Those are crucial elements, and they certainly deserve their own dedicated deep dive in the future. We will leave the listener to weigh the mechanics we've discussed today and draw their own conclusions about the time of interest hierarchy.
It's a lot to think about.
It is. But as we close, I want to bring us back to the beach we started on. We stand at the edge of the market, watching the waves of price action crash and recede. The structural patterns are beautiful, and the sweeps of liquidity are undeniably powerful, but the lingering question remains, as we try to anticipate the next massive shift in the tide, are we really watching the water? Or should we just be watching the clock?